Is discussing right now what to do about interest rates. The decision will come public tomorrow. The markets seem to think another cut is in the cards.
Our next guest agrees. Diane Swonk, chief economist for Mesirow Financial. On the other hand, Peter Schiff, CEO of Euro Pacific Capital. And I'm going to start with Diane here. Diane, tell me, is it the right decision if the Fed cuts?
Well, that's probably still debatable. I think it is the right decision in the sense of the old risk management approach that the Fed used to take under Greenspan, although under this new regime, it's not as clear. We have seen a lot of the repricing in the market come through. The asset-based commercial paper market is still a little dicey out there, but for those people on Main Street, they've not seen much of the spillover yet. And on that side of it, it's not clear how justified this cut is.
Now, Peter, you do see a disconnect between, a very clear disconnect between Wall Street and Main Street. Explain why.
Well, sure. I mean, Wall Street benefits from all this cheap money, and they can borrow money cheaply and invest it abroad, just like I'm doing. But it's not helping the economy. It doesn't help the average American to see the value of his wages, the value of his savings diminished. I mean, the British pound today is at a new high for, 30 years. This week you had new highs in the Canadian dollar.
So, Peter, let me just
euro.
understand how to fix things. I think everybody by now gets what you think the problem is, and not everybody would disagree with you. The question is how you fix it. The Fed can do several things. The Fed can make things tighter and increase interest rates as you would like. Also, the Treasury Department, though, could talk up the dollar, which I have to agree with you. It hasn't been doing. In fact, some people would say it's been doing just the opposite.
But talk is not going to help. You know, there is no quick fix. We have a big problem here as a nation, as a society. The Fed can't fix it. The government can't fix it. We need to fix it. Now, sure, the government can get out of the way. The government can reduce spending and reduce taxes and reduce the burden it places on productive society. But we have to stop all this reckless borrowing and spending. We have to stop buying things we can't afford.
How would you stop people from borrowing? Would you put up government regulations about it?
No, you let interest rates go to a normal level. People wouldn't be borrowing all this money if they couldn't afford it. You know, if we had much higher interest rates in line with where they should be, we wouldn't have all this reckless borrowing and spending. That's why the Fed should be raising rates. It doesn't mean we're going to avoid a recession.
Diane, go ahead. Diane, what's your solution?
Okay. Well, you know, there isn't any easy solution. You're right about that. But I do think at this stage of the game, given where the Fed is at, it's going to be a big debate. They will cut rates. It's because at this stage of the game, they have to. And it's not. It does help Main Street a little bit. Those borrowers who are most on the edge that didn't realize they're getting into adjustable rate mortgage, they're not the pillars of consumers of the economy. But, you know, if it stops a couple defaults from happening, that's okay with me.
But it's not going to stop. It's not going to stop
in the broader context, it will stop a few, not a lot.
Diane, is the Fed pandering to the big financial names out there who have found themselves in trouble because of bad bets they made?
You know, I hate to say that because I have so many friends on the Fed. I do think that that Wall Street has had a louder voice. With that said, let's face it, the Fed is, the plumbing of our financial system is Wall Street. And when it backs up, we don't want it hitting Main Street, and it's their job to stop it from backing up. So, I mean, it's kind of blunt to put it that way, but we don't want that on Main Street, okay?
I understand. I finally understand.
Peter, what do you think? You get the snake out into the drain and start clearing that out?
Well, you know, unfortunately,
I don't with this one, right, Liz?
I don't disagree with Diane, and I do expect the Fed to cut rates. I mean, I hope they don't. I hope they surprise me. But, you know, they really need, as I said, they need to be raising rates. Just standing pat isn't enough. And I don't even know how high they need to raise them.
Rates right now, though. That's not, it's not feasible for them to do it right now. That's just not realistic.
At some point, they're going to have to bite the bullet and do it. And the longer they wait, the longer they delay this, the worse it's going to be for every American.
Diane, let me just ask you, at what point might the Fed decide, gee, this dropping dollar is worrisome. It's going to affect the ability of the market to continue to go up because people are afraid that their assets denominated in dollars aren't going to be worth as much tomorrow?
You know, the dollar doesn't affect them as much as most people think because we've not seen as much inflation from the dollar in the last decade in particular.
Oh, yes, we have.
I knew Peter was going to chime in on that.
With that said,
Diane can't see.
Hold on. With that said, go ahead, Diane.
With that said, the real issue is a couple quarters down the road, we've always found that the Fed's cure to these financial crises has a greater effect on stimulating the economy than the crisis had itself in hurting growth. And that means they're going to have to start taking back. And if you listen to the Fed, they're already talking about, as they're giving us an ease, they're talking about recalibrating as quickly as necessary. It's always easier to give it than take it back. So by mid next year, I would like them to be taking it back. I don't think we're going to see them taking it back till late 2008. And that could set up a much larger problem for us down the road in terms of inflation.